And today I'm honored and excited to have Bob Crimmins with us. Bob Crimmins I've known for a few years now, and I'm very happy to call him a friend. He created the Startup Haven and is also just launched the Startup Haven Fund. Startup Haven is an organization that really helps support the growth of entrepreneurship, bringing together investors and entrepreneurs. I've had the joy of playing startup poker many times with Bob and the Startup Haven group, bringing together investors and entrepreneurs. And there's so much you can learn from your poker game as to how your investing works. So very excited to have Bob here today to share a little bit more about Startup Haven, the work you do, why it's important, and what you see as the impact of your angel investing and what you look to achieve. So Bob, I'm going to turn it over to you. The floor is yours. Thank you so much for giving us some time today to speak with us.
Well, thank you, Brianna. It was really a treat to get invited to. This is a subject I've spent some time thinking about from a number of different perspectives, and I'm happy to share some of those perspectives with you. And Brianna, I can't wait to see you at a poker table again soon. We're hopeful. We'll see when we can pull that off. You know, I'm just gonna share some ideas with you. I don't have a deck to share or anything like that today. I wanted to share some things and then have a conversation. I appreciate what you said, Brianna, or the theme around communication is so important. And so my hope for today is I'm going to share some of my experiences, and then I'd just love to, finish up with the Q&A and have a conversation. So please feel free to interrupt me if you like. You're not going to break my flow. I'm happy just to have the conversation. And when I first got the invitation to speak, my first thought was, oh, the impact of angel investing. Oh, you must mean impact investing. And certainly impact investing is a thing, and it's a great thing. And I've done a little of it, and I know lots and lots and lots of people who do lots and lots of it. And it is a tremendous thing. And doing good while doing well is a tremendous mission. However, that's not what I'm going to talk about. My experience, as an angel investor, but also the other work I've been doing for the last 20 plus years in the startup ecosystem also has informed that. And I would say it was informed it more. How I think about angel investing has been informed more by everything else I have done in the startup ecosystem besides angel investing. And when I think about the trajectory that I've had, and I look at what the role that angel investing plays in the overall innovation ecosystem, it's not just another asset class. It really is the foundation. It is essential that angel investment happens, and the impact. From there, you could traverse to lots and lots of different aspects of the impact, because it's the foundation. So it impacts everything. But I want to be a little bit more specific than that. So when I think about all the Series A, B, C, D companies and investors I know, all the IPOs that happen, and you think back to those very, very early stories when they were getting their first angel investment, those downstream investments and exits don't happen unless that very, very early company with that very early, often first-time founder gets off the ground to get to a position where they can make those things happen. And in my experience in the ecosystem, so I started out as a founder, and I founded a handful of companies here in the Northwest, venture-backed companies, and I learned a lot as a founder from that experience. Then I subsequently had spent a lot of time in the last 10 or 12 years really as a mentor and advisor to literally hundreds of startups in the country, mostly in the Northwest, but down in California a lot too, and then some others around the country. And then as an organizer of Startup Haven, this organization that I've been a part of now for, 15 years. And certainly as an angel investor, but also now as a fund manager, as I launched the Startup Haven Fund. And so I just wanted to share some of the things I've learned from each of those different perspectives. And as a founder, certainly, and I don't think this is necessarily obvious to every investor every time, but the impact of angel investing on founders really is immense. You as angel investors, when you're communicating with startup founders, know that it feels existential to them. To you, it's one of the 300 deals you'll look at this year, one of the, if you invest, one of the 5 checks you'll write, or 7 checks you'll write, or 2 checks you'll write. For the founder, it is everything, and that can make it feel ominous for those founders. Raising money is hard. It's not natural for most founders. There's very few companies where your ability to write an executive summary, build a deck, and give a pitch is fundamental to the business, is rare. But as a venture scale startup, your ability to succeed is based on your ability to do that thing. You may have the best product in a great market with the most happy customers and scaling revenue and all this, but if you're poor at communicating those things to investors, you'll have a struggle, and it's a non-trivial struggle for many founders, especially in the early days when they're just learning this. I just talked to a founder this week who talked to their second investor ever in the history of their company. The company's been around for a few years. They're approaching $1 million ARR. They've never raised any money. And now he has to talk to investors. And he'd never done it before. And the first 2 go-arounds, it was about a 50% hit rate. One of them went pretty good. The other one was, the investor I followed up with him afterwards, the comment was a disaster. And this is a smart, scrappy founder who has built a company, a great product in a great market with training revenue, but pitching, communicating with investors, not a strong point. So it's super, super hard for him. He needs to learn this, and he will over time. He's just very, very early in his trajectory. And understand, as angel investors, you're naturally going to see a lot of those kinds of founders, right? You're not going to see a lot of Series B, C, D founders who have gotten that executive, that street MBA over the last 7 years of growing their company and raising lots of money. So when you're an angel investor and you're making early angel investments, almost all the founders you work with are going to be struggling. And remember too, that for a founder, what I tell founders when they say, "Oh yeah, I'm going to raise money." Okay, are you sure you're going to raise money? So how are you going to do that? And what's your process? And what's a good investor? And how are you going to? All these things are important for them to understand, because it's not obvious to them. And if they don't take those things serious, that is, fundraising is a process, and there's a way to do it right, and there's a way to do it wrong. And if you don't know the right ways to do it, you're going to spend an incredible amount of time. It's going to be such a distraction of the business. In fact, some companies in the effort to raise money, they'll spend 6-9 months, a year, trying to raise money, and that's 70+% of the CEO's time while all that's happening. And the story to learn from that for an angel investor is, again, back to communication. That's a really terrific theme. I just want to say that again. Tell that founder no. Say, you know what, I really like you, I like what you're working on, but this is not a good fit for my strategy. Or, I'm not liquid right now. If you're, if whatever, say no as quickly as you can. If you don't feel conviction early, and you're anxious to get to the next call, it's probably going to be a no, because you're not going to make 50 investments this year, right? So, if at the moment you think it's not a good fit, let the founder know, look, it's nothing personal, but it's not a fit for where I'm at right now. That's the best thing for a founder to hear, because it releases you from their mind. Because when a founder starts raising money, they start with a spreadsheet, like, who are all the investors that I should reach out to, and they're sending them out to their mentors and advisors. Can you add some people to the list? Can you make introductions to this list? And the most, I think the most helpful thing I ever do when I get that spreadsheet is I cross people off the list. This person's not investing. This person's not liquid. This person, you're not at the right stage. They'd never invest in that sector. But until they get that, they think that's one of the investors that I have to put through their process. And they just spend an immense amount of time. So the sooner you can let a founder know whether or not it's a good fit. And you don't have to say no in a bad way. You can say, look, it's not a fit right now. What I would like to see is this. If it's a sector you never invest in healthcare, you never invest in hardware, you never invest in highly regulated things or vices or whatever, tell them that and just move on. If it's something that in principle you think could be good, tell them, in principle, I like what you're working on. What, in order for me to invest, I'd have to see this. And be specific, and don't make it that thing that when they bring you that, then you say, okay, now here's the next thing I need to see. Think about it for a minute and say everything that you know about this company, for where they're at and who they are, what would make you want to invest? And if you want to see, 50,000 in MRR, tell them, you know what, I would find your business attractive when you get to about 50K MRR. Right now you're at 3K, I get it, but and you have an out, your thesis. It's not a fit for your thesis. And just let them know it's not a good fit right now. When you get to this certain point, please reach out again. That is a terrific message to send a founder, because then they can turn you off, because you are screaming in their mind. All these 100 people on their spreadsheet are screaming in their mind all the time, because they got to do follow-ups and send decks and they're doing just a ton of mental gymnastics with all these investors that they're reaching out to. So be straight with them, communicate quickly. If it's a no, say no in the best possible way. If it's a maybe, tell them what would have to be true in order for it to be a yes, or at least for it to be something you would consider. You don't have to commit to something they're going to get to 4 months down the road. But in any case, be as transparent and as quick, frankly, as you can about your communications with these founders, because they're struggling. This is a hard thing for them to do. And it's often the case that, and it's not on purpose, as angel investors, we're often, sometimes intentional, I guess, we're kind of opaque, right? We're busy too, and we got a lot in, and the founders don't understand how investors think about things. And they don't, the number of founders, if you tell them, you just pitch to an investor, how many investments do you think they'll make this year? How many deals do you think they'll get introduced to? How many do you think they'll actually take a look at? How many of them do you think they'll actually do some diligence on? How many of them do you think will have a conversation about terms? The vast 99% of first-time founders have no idea the answers to any of those questions, right? They think, oh, you're a rich person with money and I'm supposed to ask you to give me a check. And that's often just the extent of their understanding of how a fundraising process works. So be kind, you'll make a friend. When they do hit it big, they're going to come back to you and say, hey, you didn't invest, but you were kind and you were helpful and you were honest with me. And so look what we just did. And we're raising a seed and I'd love to have you involved. So that communication stuff and remember all those things taken together, make it, if you talk to founders who have raised money multiple times and you say, yeah, fundraising can be soul crushing, they will not disagree. It can be super, super, super hard in so many ways. So your impact as an angel investor, first of all, making angel investments makes the world go around. But how you interact with founders has a huge impact too for those founders and for you. If you're straight with a founder and you make that friend and you treat them well, and even though it's not a good fit for you, you try to do something to help them, make an introduction, give them some feedback. All those things put you in the class of, oh, that was a good investor. They didn't invest, but when I hit it big, I'm going to go back to them. So remember the impact on the founder. And then as a mentor and advisor, which I've done quite a bit of through Techstars and Alchemist and 500 Startups and YC and some other accelerators, working with companies from those accelerators. The help that an accelerator company gets, in that last month of the program is often focused around fundraising. So they all get a pretty good education in a fundraising process. But for the 95% of other founders who never get into an accelerator program, those startups don't understand the fundraising process. And that's one of the things that I try to help them understand is that fundraising process, which kind of investors and understanding that this investor is going to see, 300 deals this year and they're going to write 7 checks. So that's what you're up against. That's why you need to be really careful about who you're spending time talking to and how you talk with them and so forth. All those things are kind of what I've done in the angel investing space in terms of advising and mentoring. And then as an organizer, Startup Haven, which started quite by accident 15 years ago, I wanted to learn how to play poker. I asked my friends to come play poker once in a while and let's learn this game. And it turns out virtually everyone I know in the world is a founder or investor. So guess who started coming? And that thing sort of took on a life of its own, and it's grown and grown over these last 15 years. And so now we have chapters in 7 cities, 2,300 founders and investors. We're also a membership organization. We have a very, very tight vetting process. You have to apply. You have to be a full-time venture scale founder with some elements of traction in your company. You can be early, But if you're still idea stage, you haven't quit your job, you're not qualified. And then we have investors who are angels, funds, and institutional VCs. Institutional VCs, funds, those are easy. Angel investors, there are some angel investors, like what I assume if you're part of Keiretsu Forum, you're actively interested in finding your next investment. Not every angel investor thinks of it that way. They think of it as, yeah, I wrote a check 3 years ago and I might make another one in the next couple of years and I'm an angel investor, and that's fun and that's great. There's nothing wrong with that. Everybody invests at their own pace. But for Startup Haven, we want angel investors who are proactively seeking their next investment. They don't have to make an investment in any Startup Haven company or any Keiretsu Forum, right? But they have to be in the mindset that, yeah, I'm interested in investing. I want to invest more, and if I find a great company that fits my thesis, I'll want to dive in. So we look for those kinds of angel investors to be involved. And for Startup Haven, one of the reasons that Startup Haven has lasted this long, which has been a passion project, it started 15 years ago. It's never made a profit. It tries just to help founders and investors. And the secret to its success is just making sure all the right people are in the room. So creating conditions where everyone in the room, like Brianna, when you go to a Startup Haven event, someone from a sponsor might be there. There might be a couple people there or sponsors, but the other 65 people, they're all venture scale founders and investors. And if you can get those kinds of people in a room, magic happens. And over all these years, one of the most gratifying things that I see happen over and over and over again is founders meet investors and investors meet founders, and they get to know each other. And it's not always a fit at first, but my favorite story to hear from founders, and they say, hey, Bob, by the way, I didn't tell you this, but last year we actually raised from 3 investors at that poker game. And thank you for that. That was amazing. So, I don't always have real-time data on these things, but I know over the years, we had a tremendous impact on connecting investors, angel investors principally, and making those connections. And so to me, that's a really important thing, because if it's true, if you accept the premise that angel investing is impactful, that it's important in the ecosystem, then scaling that is an important and valuable thing to do. So Startup Haven, the reason that it kept going, the reason I kept spending 10 or 15% of my time on it for all of those years was because I saw that impact and I wanted to scale that impact. And so that's why that was around, and that's why I continue to grow it, because I wanted to scale that kind of impact. And then for my experience now, having been a small angel investor over the years, but now actually launching a fund and an accelerator through Startup Haven, and that was born out of my experiences as a small angel investor, but as I said, more so out of all of these other experiences that I've had in the startup ecosystem as an organizer and a mentor and advisor and founder and so forth. And so when I looked at what I was going to do next, this was a few years ago, and thinking about where could I have the most impact in the startup ecosystem, focusing on investing was the answer. And for me, with my experience in organizing and mentoring and advising and working for mentoring for accelerator programs, that meant early stage. It meant basically scaling angel investing. Not, I wasn't going to launch a Series A, B fund. I was going to launch a pre-seed fund. We're going to make lots of small investments in companies that we could leverage that Startup Haven network and all those amazing experienced founders, investors to find and fund these companies. And the nice thing, which some of you, if you're early angel investors, you might not know this, so I'll share this with you. There's a reason that some accelerators do well, and part of it is in the terms. So if you were to meet any startup on the street and they're raising capital, and you're going to invest in them, and if they're a good company, good founders, you hope that you make an investment somewhere around market, whatever reasonable terms would be for that company at that stage. With an accelerator, the accelerator attracts great founders who value that kind of support, and they're willing to trade equity for that support and those connections. And so when an accelerator makes an investment in a company, they're trading some equity just for the value of the program, which means the effective valuation of that investment is often tremendous. So for us, we offer a $20,000 investment for 5% of the company, and then $100K convertible note at 100K, I'm sorry, at 3 million pre. So our effective evaluation is somewhere south of 1.5 million for a competitively selected team that's going to get a ton of help. And they're going to use that capital to get to a next milestone. That's actually an important factor of our accelerator. But that then becomes a way to scale, the number of companies that we can invest in with an accelerator is greater than the number of companies that we could deploy that same amount of capital to without an accelerator. Now, accelerators are great. Not every company is a good fit for an accelerator, and there's a lot of really great companies and founders we want to invest in at that sort of angel level. But the accelerator doesn't make sense. So for the Startup Haven Fund, we're operating in that first round, that those rounds that angels would participate in, and we're writing 100K to 300K checks, and we're doing it both directly and through the accelerator. So we'll invest in 40 to 50 companies, and valuations typically under 5 million, and that's a lot of checks we get to write. So again, if you believe the premise that writing lots of sort of angel-sized checks into angel-sized rounds is a good thing for the ecosystem, then I'd like to think we're doing something pretty good, because we're going to write 40 to 50 of those checks, which wouldn't have gotten written that way. Hopefully, some other angel investors would have come in and filled the void. But the reality is, very early stage funding is hard. It's hard for startups, and it's an important part of the ecosystem. Now, but what about for angel investors? So for when I think about the fund, it's like, isn't it great that the fund gets to write all these checks and gets exposure to all of these companies? And when I designed the fund, because we have so many investor members at Startup Haven, and I knew that a lot of those folks who are active angel investors would want to participate in the fund, we structured the fund sort of ideally to support angel investors. It was actually part of the thesis when I built the fund to think, I don't want to just go get 3 family offices to write me big checks and then we'll go invest. I knew that we wanted to have an LP that had experienced founders and investors who were part of that LP. And we've had a second close. We have a tremendous gathering of amazing angel investors, many of them who were founders who became investors, which is a really terrific asset for the fund to have that expertise in the LP to help source companies for sure, but then also to help those companies. And we're a very interactive organization, a very interactive fund. And so as an example, actually last night was a big night. Last night, the sign above my head up here said Startup Haven Accelerator. We had our graduation last night for our first funded cohort of our accelerator. And we invited all of our LPs, and most of them came. And many of them followed up with me afterwards. They're going to help these companies in various ways. If we had just family office investors, that wouldn't have happened. Engineering the LP to me was an important part of the fund. And so as we continue to grow the fund, of course, the SEC has something to say about that. And so, we have to do all this within the constraints of the 99 investor limit. But, the fact that we have just these really tremendously experienced founders who become investors, and investors who are knowledgeable and active as angel investors and want to do more. So one of the things, for example, we do in order to help scale angel investing is to pass all the pro rata onto our LPs. So when we invest in a company, we secure pro rata, but rather than have the fund make that investment, we do a hand raise with all of our LPs. Hey, do you want to participate in this follow-on? Those are a lot of small checks. And so each one of those investors gets to exercise that angel investor muscle more and more over time. We do that with co-investment too. We've actually brought more co-investment to our LPs than we've actually brought deals so far, which is gratifying and a little unexpected. So in any case, so that's when I think about how to help angel investors, giving them that opportunity. Which, by the way, if you're not familiar with Rob Wilbank from Willamette, has he ever come and spoke for you guys? He has,
yeah. We look at a lot of his data and a lot of his work, and we have one of his former students, is a member of our team.
Oh, that's terrific. Yeah, so he's just aces with sort of results-driven data for angel investment, and I learned a lot from him. And also, Right Side Capital, if you're familiar with Right Side Capital, highly quantitative investment fund in Silicon Valley. And I think they have 1,000 companies in their portfolio, and they're all about data. And so they, for them, for Rob, I think he'd say the minimum portfolio size to start to mitigate some of the idiosyncratic risk of being an angel investor and making one-off investments is around 20 or so, 20 or 30. And then Rob thinks the law of, large numbers and mathematics gets involved, and you have better chance of overcoming the idiosyncratic risk of lots of startups are going to fail. In right side, their number, which is much more sort of scientific and rigorously mathematical, they set it at 100. And at 100, you've eliminated the idiosyncratic risk, and you're going to do as good or better than the average returns. So for me, I know that my investors in the fund are going to have 40 or 50 more companies that they've effectively written fractionally small checks into, and that is sort of a natural amplifier of portfolio. As a fund, that was an important part for me, not just to be able to invest in those founders, but also to have investors who wanted to do more angel investing. And so that's sort of how we structured the fund.
That's great.
So that's sort of my experience. Is there, I don't want to go over time. I'm not over time, am I? Tell me.
Well, we're at time.
Okay.
I wanted to leave a few minutes for questions if anybody had any questions. I haven't seen any come into the chat window, but you can feel free to take yourself off mute or raise your hand if you have any questions for Bob. I do have a question, Bob.
Yeah.
Out of all the years that you've been doing this and working with founders, what is your number one red flag when you talk to founders as these, investors are looking to help and looking to support? What worries you?
The number one, so, it might take a little bit of explanation, but it's a cogent story. Like when I talk to a founder, and the accelerator is actually built on this principle. A founder is great at product. They're great with their customer, and they, the good ones are trying to build something bigger than themselves, and they have vision about where it could go. But for me, I want to hear from here to their story, because the failure rate is so high, and having been exposed to so many startups over all these years, I've just seen so many great teams. Team is super important. If I had to pick one other factor, it's the team. I want to know that founders. I'm looking for a really great founder. And then the cogent story, because you can have all the other things, even a great founder, that's no guarantee. You have a great founder, great market, great product, revenue, some funding, and they can still fail. So, the most reliable thing that I have found over all of these years is that if you have a founder explain what their next strategic milestone is, what that will unlock if they get there, when they will get there, and how they'll get there, and have them tell you that story. And that story will involve some numbers, right? And if they say, oh yeah, and I hear this all the time when I get pitches right now, hey, this really big thing is about to happen. Now's the time to get in. If in 2 months, we're doing this big deal with this guy. I'm like, oh, okay, good. So walk me through that. Who is that customer? How fast will they react? What are they going to do? How long will it take? Right? What other things are required? Like, have them explain to me how they're going to reach their next right strategic milestone. That lets me hear how they think about growing their business, because being successful in a startup in the early stages is about jumping from one lily pad to the next. I get it. Great vision. Awesome. I hope you get there. Most don't get there. So where do you need to be next? And why is that the right, important next place to be? And if it's less than about 3 or 4 months out, then I think it's an operational goal. That's great, but it's not impressive. If it's more than 6 months, I wonder how your headlights go out that far. So 4 to 6 months, tell me where you think you need to be for this company, what that will unlock. Now I know that they're not just, pointed in a direction and kind of working hard and fast in a direction, thinking that's going to work, because that often does not work. And so being so cogent about how you think about where you need to be next, that's my biggest green flag. If they can do that well, I just want to invest. If they can't do that, if their story does not hold water, then I'm a wait and see, and hey, not a good fit, and here's why, and let me give you some feedback on that, and here's where I think your next strategic milestone should be. Tell me I'm wrong. And then they learn a little something, and I feel like I'm making a better investment decision, because at least I have a good idea the next place they need, not where they're going to be in 7 years when they raise their Series D. I had a company send me a deck. And it had all of their next 4 fundraising rounds with the dates they were going to do that and when they're going to IPO. Oh, what do you do with that, right? There's no cogent story to be told about that. So yeah, cogency is my thing.
We have about a minute left. We have a few questions here in the chat, and so maybe if we don't get to them, you can answer them after. But with these, so Robert Wiltbank preaches due diligence, and really what we've seen with our own capital fund is the diligence that we've been able to conduct on these companies has really helped to impact dramatically that failure rate. In our first fund, we currently have about a 14% failure rate, which is incredible over 40 companies to have that low of a failure rate. With these pre-seed companies that you're looking at investing in, what do you anticipate of those pre-seed companies with this fund will exit?
As a percentage basis?
Yeah.
Yeah. So my portfolio model, which I have, I'm sort of an Excel geek, and I built an entire portfolio model on this. And you have to make some. I basically make assumptions, what I think are coding assumptions about industry standards. Like what I'm not saying I'm going to beat everybody else. I'm saying, I'm going to say at least half of the companies are going to go to 0, return less than 1. And they're, and then my model is very, it's a model. It's meant to say, well, so if I invest in this many companies at this valuation with this check size, and they have these kinds of outcomes, and then a Monte Carlo analysis simulation to say, okay, here's the range that those companies are going to fall in based on assumptions around how many will fail, how many will be, a triple, how many be a home run, how many will be holy hell, massive exit. And I tweak those. And then I get feedback from other fund managers. I'm blessed to have relationships with a number of very experienced fund managers who can check my work and say, well, Bob, that assumption is not quite right. And I learned a lot in the early days. So I take a portfolio management, or I'm sorry, modeling approach. But yeah, certainly 50% of my investments I expect to go to 0.
Yeah.
I don't want them to. I'm going to try to make that not happen. But I have no cogent defense that won't happen.
Well, thank you so much. Your passion is just infectious with this topic. And thank you so much for being on and sharing with us a little bit about you and Startup Haven and just the work that you've done over the last 15 years.